Hi there, and welcome to Hardman Talks. I'm Larissa Adams from Hardman & Co, and today I'm joined by Paul Mylchreest, our metals and mining analyst. Paul has covered our sector, the mining sector since 2005, and has a background as a macro strategist. So today we'll be diving in to talk about Paul's recent note covering China's debt issue, specifically the real estate crisis and shadow banking, and what the implications would be on gold prices and gold stocks globally. So Paul, thanks for joining us. How are you today?
Yeah, I'm very good. Thank you, Larissa.
Brilliant. Okay, so I guess some investors aren't too familiar with the investment case for gold. So can you give us a little bit of a background on that?
Yeah, gold isn't generally that well understood, I think, by many investors, which is ironic because it is probably the oldest financial asset in existence. But let me highlight several of its attractions. Firstly, it's the only financial asset which isn't somebody else's liability, whether that's a government, a company, or an individual. So it has no counterparty risk. The Bank for International Settlements classifies gold as a Tier 1 financial asset, having zero credit risk. Gold also has no or minimal correlation with other financial assets and often has a negative correlation with equities, and that makes it attractive for diversification in portfolios. It's also the only asset which outperforms in either inflation or deflationary conditions, and historically debt cycles end in one or the other. So investors tend to accumulate gold in the later stages of debt cycles, which is where I think we are now, when gold is the safest place for protecting wealth, and investors become increasingly concerned about the risk of financial instability.
Okay, thanks, Paul. So I assume you think there's a risk of financial instability, and if so, where do you think that might stem from?
Yeah, I do expect financial instability. I would be amazed if we didn't have it on the horizon. We're in the longest debt cycle since the Industrial Revolution, if not going back longer, but that's as far back as I've looked. This debt cycle has been unfolding since the bottom of the Great Depression, which was 1933, so it's now 90 years long. It's also the biggest debt cycle since the Industrial Revolution. We've got debt to GDP levels which are well beyond those reached during the Great Depression, and that's without taking into account the quadrillions in derivatives, which are basically unanalyzable. And this debt cycle is not confined to one country or one region. It's global. And I think in the last few decades, we've become conditioned to assume that financial crises start in the West and that they're really a Western phenomenon. We had the '87 crash, we had the technology bust in the early 2000s, and then we had the great financial crisis after Lehman. And early this year, we flirted with another banking crisis which stemmed from the US with the failure of Silicon Valley Bank. If you cast your minds back, the Fed had been increasing interest rates very rapidly, and that led to huge losses in bond portfolios on bank balance sheets. And when customers pulled their deposits, we basically had an old-fashioned bank run, and banks were forced to sell bonds, which crystallized their losses and made some of them, like Silicon Valley Bank, insolvent. And it was only because the Fed stepped in with a $400 billion credit line from the Federal Home Loan Banks and also the Bank Term Funding program, which is currently at a record, that we didn't go into a financial crisis then. And if you look at what happened to gold during that period, on the 8th of March, when the crisis began, gold was sitting at $18, $13 an ounce. And by early May, it was over 2,050. But I think the point to make is there is no rule in terms of the West, where the next crisis is going to come from. It doesn't have to be in the West. And I think there's as much chance that it starts in China.
Okay. So, I mean, why do you think that's the case? Why do you think it's going to begin in China, and what are the risks?
Yeah, so to put it simply, China is in a huge debt bubble. And if you cast your minds back, it barely suffered during the great financial crisis, which hit the West so hard. If you remember, the Lehman failure was, if I remember, October 2008. China's GDP growth in 2008 was plus 9.7%. In 2009, it was plus 9.4%. It was barely changed, whereas OECD GDP growth fell 3.4% in 2009. Now, why was that? How did China come through unscathed? And it was basically an unprecedented expansion of debt. And that turned the driving force of China's economy from exports to the rest of the world to domestic investment. So if you look at the total debt in the Chinese economy in 2008, it was about 5 trillion. Compare that with now, where it's more than 52 trillion. And you have a total debt to GDP ratio that's in excess of 300%. The US, in the depths of the Great Depression, only got to around 270% of GDP. And there are many signs that the Chinese economy is going the wrong way. So second quarter GDP growth was only 0.8% up versus the previous quarter. The CPI has been flirting either side of deflation. And there are two interconnected sectors which are in crisis, and these are real estate and shadow banking. And if I just look at those two briefly, real estate, some people estimate is somewhere between 25 and 30% of China's GDP if you take into account the whole of the supply chain. And Chinese real estate is probably the biggest single asset class globally, worth in excess of $50 trillion. Even the US equity and bond markets are slightly below $50 trillion. And if you look at what's happening to house prices in China, the National Bureau of Statistics estimates that house prices are about 6% off their peak. But that's based on specific sampling, not actual transaction data. Bloomberg and other analysts are putting the fall at more than 15%. And if you look at the two largest real estate developers, Evergrande and Country Garden, they have liabilities. In the case of Evergrande, it's $328 billion. And in the case of Country Garden, it's $199 billion. These are huge companies, and both have missed interest payments recently and are trying to restructure their debt. And then there's the other piece of the jigsaw, which is shadow banking. Lending by Chinese companies which don't have a banking license is probably something in the region of $7 to $8 trillion. So that's about 40% of China's GDP. The most common forms of this lending are wealth management products and trusts, basically because they offer higher rates of interest than bank deposits. So investors give their money to these wealth management products and trusts, and they're invested in real estate projects and local government. Now, one of the largest of these shadow banking operators is called Zongrong, which has $86 billion in trust assets, and that's missed about $20 million of interest payments recently. And the financial regulator is stepping in and is having a very close look at its books. So there's some real risk there as well.
Okay. I think let's maybe take a step back and just think, what would be the big picture impact for investors? And what would it be? What would it mean for gold and gold mining shares? And then I think it's also, what could investors be looking out for in the next coming weeks?
Yeah. So, what got my interest was that the word contagion has started to be applied to the real estate market in China. So far, the main impact, if you like, in markets has really been to push the Chinese renminbi, so that the currency, to the lowest level for more than a decade against the US dollar. It's currently trading around 730. What Chinese policymakers have done so far is really to take measures to try and protect the stock market. They've lowered margin requirements. They've cut stamp duty. And you can see what they're doing. What they're trying to do is avoid a sell-off in the equity market, because that would send tremors through the real estate market and damage confidence there even more. But it's my sense that China's policymakers are probably behind the curve in terms of dealing with real estate and shadow banking. And so far, they've not responded in their normal manner, which is very heavy-handed monetary stimulus, which is what they've tended to do in the past. But I think, if China doesn't get to grips with the crises in these two sectors, I think there is the chance of a Chinese credit event. Now, that would impact global asset markets across the board, but I think would be very positive for the gold price. Secondly, if they do get ahead of the curve in terms of saving real estate and shadow banking with bailouts and stimulus, and just to put it in context, I've seen one estimate recently that suggests that you'd need about $1 trillion to save the Chinese real estate market. Someone described it as being too big to save. If they do get ahead of the curve, I think it would be the Chinese currency that would continue to bear the brunt of the adjustment. And you'd see, significant FX outflows, and I think a big move by Chinese investors into gold. And it's worth noting, in terms of local currency, the gold price in China is trading very close to a record high. The chart looks extremely bullish. And it's worth noting that China, along with India, are the world's biggest investors in physical gold. And I don't see that changing. From the Western perspective, we tend to be more balanced in terms of buying physical gold, but also buying gold mining shares. And perhaps one way of looking at this is to look at some of the major ETFs. So there's an ETF called the GDX. That includes most of the world's largest gold mining companies. And if you look at that chart, you can see there's very little investor excitement. The chart's really been trading sideways. But from Hardman's perspective, what's perhaps a bit more interesting is the GDXJ ETF, because that consists of a number of junior gold mining companies. And they tend to be the stocks that we focus on at Hardman, the smaller caps. And if you look at that index, it's trading something over 75% below its peak in 2011, showing that there's really not very much interest, or hasn't been in recent years, much interest in these stocks. But I think the point to make is, from my perspective, looking at the investment case for gold, I would just mention that, it tends to be these small gold mining shares that are actually more leveraged in terms of their share prices to a rise in the gold price. So this is what I'm thinking we're going to see going forwards.
Okay, thank you so much, Paul. I think we'll have to leave it there. There's lots for investors to digest. But thank you for joining us. So to our viewers, please don't forget to like this video and join the conversation wherever you're watching. We appreciate your time, and we'll see you back here on Hardman Talks next time. Thanks.